Hello learners, this is Jyoti Mandral. I am an assistant professor in Department of Management Studies at Uttarakhand Open University. In today's lecture, we are going to discuss regarding the secondary market. The learning objectives of today's lecture are firstly, we have to understand the meaning of secondary market, then to get an overview of secondary market intermediaries, then to explore the functions of secondary market, and after that we will discuss about the types of secondary market. Now firstly, let's start with the introduction. So, the secondary market is a place for investors to exchange company shares. It indicates that investors are free to purchase and sell shares without the issuing firm getting involved. The issuing firm does not generate income in these investor transactions. Instead, the market performance of company determines the share valuation. Therefore, the sale of shares from one investor to another is how income is produced in this market. Secondary market is also known as stock market, or we can say stock exchange. Existing securities can be bought and sold on this market. It encourages new investors to join the market and current investors to leave. It also promotes economic expansion by using the disinvestment and reinvestment process to allocate money to the most profitable ventures. It also promotes economic expansion. Securities trading, clearing, and settlement are governed by SEBI's regulatory framework. Thanks to developments in information technology, as trading terminals have made it feasible to trade on stock exchanges from any location in the nation. Now let's discuss regarding the secondary market intermediaries. So the first one, that is stock brokers. Anyone who is a member of a stock exchange and registered under the SEBI, that is Securities Exchange Board of India. So stock brokers and sub brokers rule 1992 is considered a stock broker. On behalf of investor, they buy, sell and trade securities. Examples of stock brokers are Zerodha and Angel Broking. Then the next intermediaries are sub-brokers. These are individuals who work for stock brokers but are not stock exchange members. Through stock brokers, they assist investors with the purchase, sale and trading of securities. Some examples of sub-brokers are Bizal Stock Brokers and Arihant Capital. The next one is portfolio manager. These are the people that advise customers or look after a client's stock or money portfolio. An investor's collection of securities is called a portfolio. The next one is custodian. A custodian's duty include protecting a client's securities and offering auxiliary services related to that protection. Numerous well-known banks that are registered with SEBI serve as custodians. Now let's discuss the secondary market functions. Secondary market is essential to the economy because it facilitates investor engagement, price discovery and liquidity. It facilitates effective capital movement by bringing together buyers and sellers of securities that have already been issued. So the first function of secondary market is liquidity to securities. The secondary market gives investors a simple way to purchase or sell securities when needed. It guarantees that investors can swiftly turn their securities into cash For instance, an investor who owns Reliance shares can sell them at any time on the stock exchange to receive immediate cash. The second function, that is determining the fair price. Based on supply and demand, it aids in determining the security's fair market value. Real-time price fluctuations are caused by shifts in news, corporate performance, investor attitude, etc. It reflects the company's current valuation and aids investors in making well-informed selections. The third function, that is promotes the creation of capital. A busy secondary market attracts additional investors to the main market even when the company does not raise money directly from the secondary market, because investors are aware that they can sell their securities at any time if necessary. Increased investment participation boosts the economy and industries. The fourth function is that the secondary market guarantees security and openness. Authorities such as SEBI, that is Securities and Exchange Board of India, oversee the secondary market through laws, guidelines, and monitoring to stop fraud and guarantee ethical behavior. It enhances investors' confidence and defends their rights. The next function is securities and company valuation. Aids in determining the listed company's market value. Government analysts, investors, and businesses themselves all use it. Securities valuation is crucial since decisions involving mergers, acquisitions, taxes, and additional capital issuance all depend on accurate valuation. The next function of secondary market is it encourages investment practices. It encourages the people to invest by providing freedom and chances for profit through consistent trading. It lowers unused savings and redirects funds to the economy's more useful uses. The next function, that is ways to diversify your portfolio. Equity, debt, mutual funds, exchange traded funds, that is ETFs, and other assets are available on the market. It is significant because investing in a variety of instruments or industries allows investors to lower risk. It leads to more steady results and balanced portfolios. The next function is offers investors an exit route. Securities purchased by investors in the primary market are always available for sale in the secondary market. It enhances market efficiency and boosts investors' trust. Now next we are going to discuss the secondary market types. Secondary market is divided into several groups. Stock exchange and over-the-counter market are the two main groups taken into consideration. The first one, that is exchange for stock, or we can say stock exchange. So the stock exchange is a centralized platform for trading securities. Investors who do not directly know one another trade with one another. When it comes to buying or selling shares, just the price matters. The Securities and Exchange Board of India, or SEBI, has issued stringent guidelines that exchanges must abide by the order to list reliable securities for trade. Exchanges are therefore the safest trading solutions for investors. By offering a commission and an exchange fee, stock exchanges services can be utilized. Examples of stock exchange are the New York Stock Exchange, the Bombay Stock Exchange, the National Stock Exchange NSE, the London Stock Exchange LSE, and the Hong Kong Stock Exchange and the Frankfurt Stock Exchange. Now the next type of secondary market, that is over the counter, that is OTC market. The OTC market is a decentralized platform that deals with individual investors or participants. It differs from the stock exchange in that it does not have strict rules and regulations. It is highly competitive. Investors attempt to accumulate larger volume of stocks for future trading, which leads to price fluctuations among participants. A broker dealer relationship endures, and the stock of those companies are listed under the OTC market that do not meet the requirements to be listed in the stock exchanges. Examples of OTC market are Forex, that is foreign exchange, OTCI, that is over the counter exchange of India, venture market, etc. The derivative markets are also included in the OTC market. Derivative markets are those where underlying assets or commodities are put as a stock. Example, oil, rice, coal, etc. So, after covering this lecture, the learning outcomes of this lecture are, see, from this lecture, we have understood the meaning of secondary market, and after that we have got an overview of the various secondary markets, the two types of secondary market which we have discussed, and then the various functions of secondary markets were also discussed in this lecture. And after that we have also, and in this lecture we have also discussed regarding the various intermediaries of the secondary market. So that's all for today's lecture. Thank you.